Have you ever looked at a big city building and just wondered, what's its story? Well, in the world of accounting, that story is told through a surprisingly complex web of rules. Today, we're going to unravel how a whole bunch of IFRS standards can apply to just one single building, all depending on its job. Let's get into it. You know, this whole explainer was sparked by a simple but pretty brilliant question someone had on a walk. And it turns out the answer is a lot. That one building could be subject to at least 8 different major accounting standards. How is that even possible? Well, that's exactly what we're here to figure out. So, to make sense of it all, we're not just going to list a bunch of rules. That would be boring. Instead, we're going to follow a building through its entire economic life, from the moment it's just a plan on paper to the day its purpose might completely change. Our journey has 3 key stages. First, construction, literally from the ground up. Then, operation, where the building starts its career. And finally, the final chapter, when it's time for something new. Let's kick things off right at the beginning. You might think the accounting starts when the building's finished, right? Nope. Before a single brick is laid or a window goes in, the rules are already kicking into gear, and this first stage is all about one thing: the cost of money. And the very first standard that comes into play is number 23. This one is all about how we handle the money that's borrowed to make the whole project happen in the first place. That's right, IAS 23, for borrowing costs. So here's the key idea. If you take out a loan to finance the construction, the interest you pay isn't treated as a regular monthly expense. Instead, it gets capitalized, which is a fancy way of saying it's added to the building's total cost. The logic here is that this interest is a direct cost of getting the asset ready for use, so it actually becomes part of the building's value on the books. Okay, construction is finished. The building is standing there, shiny and new. Now comes the single most important question you can ask, one that will decide how it's treated in the books for years and years. And that question is simply, what is this building's job? Is it a home for your business? Is it an investment to make you money? Or is it a product that you're planning to sell? The answer? Well, it changes everything. Let's start with the 2 most common paths. On one side, you might use the building yourself, maybe as your company headquarters or a factory. On the other side, you might be holding it just to make money, either by renting it out or just waiting for its value to go up. These 2 different purposes send us down 2 very different accounting roads. So if you're using the building for your own operations, it falls under IAS 16, Property, Plant, and Equipment, or PPE. Just think of it like a long-term tool for your business. And because you're using it, its value gets slowly expensed over time through something called depreciation. It's just a way to account for the wear and tear over its useful life. But if that exact same building is held to bring in rent or for its investment potential, you gotta switch gears and use IAS 40 for investment property. See, now it's not a tool, it's a financial asset. So instead of depreciating, it's often valued at its fair market value, basically what it's worth today, which makes total sense because its value to you comes from the market changing, not from you using it up. Okay, so we've got using it and investing in it. But wait, there's a third major possibility. What if you didn't build it to use it or to hold it long term? What if you built it specifically to sell it? In that case, we pull out a totally different rulebook, IAS 2, Inventory. Yep, for a real estate developer, buildings aren't PPE or investments. They're the product. They're treated just like boxes of cereal on a grocery store shelf, just sitting there waiting to be sold. So we've covered the big 3 classifications: PPE, investment, and inventory. But the story doesn't end there. Over a building's long life, all sorts of other situations can pop up that trigger even more specific rules. A few other standards can definitely come into play. For instance, if you lease the building out to someone, or if you're the one leasing it, IFRS 16 on leases tells you how to handle that. Then there's IAS 36. This is the one you hope you don't have to use. If the building's value suddenly tanks, maybe there's a fire or the local market crashes, this standard makes you test for impairment and record that loss. And remember how we talked about measuring investment properties at market value? Well, IFRS 13 is the detailed rulebook that tells you exactly how to calculate that fair value so it's reliable and consistent. All right, let's fast forward to the final chapter. After years of being an office or an investment, management makes a big call. It's time to sell. This one decision triggers one last really crucial accounting shift. And this is where IFRS 5 comes into the picture. The moment a building is officially classified as held for sale, its whole accounting identity changes. It's no longer a long-term asset that you're using up. And the most obvious effect? You stop depreciating it.
immediately. The logic is that its value is now going to be recovered from the sale, not from its ongoing use. So the whole idea of a wear and tear expense just doesn't apply anymore.
Whew, okay, that was a lot of ground to cover for just one building. But when you step back, it all boils down to a pretty clear logic. So let's pull it all together with a kind of accounting x-ray to see the whole picture at once.
This table lays it all out pretty clearly. As you can see, everything, and I mean everything, comes back to the building's purpose. Whether it's your own office under IAS 16, an investment property under IAS 40, or it's waiting to be sold under IFRS 5. The job dictates the rule. It's as simple as that.
So we walked through at least 8 major standards. It really shows how a simple physical object can have such a complex financial life, doesn't it? Which brings us back to that original question. But now I'm going to pose it to you. Having seen all this, what other standards do you think could possibly apply to a building? It's a fascinating puzzle to think about.